Hey, good morning, afternoon, good evening, depending upon where you're living. You know, we have members from all over the globe, which is pretty amazing and great to have you taking the time to join us for this morning's event, Building an ETF Portfolio the Right Way. I'm John Hopkins, one of the founders of EarningsBeats. Tom Bowley going to jump in with the meat of the program in just a minute. I want to thank everybody for taking the time to join us. If you're new to EarningsBeats, appreciate you coming in to listen to us for the first time. We've got seasoned veterans, some that have been with us since we first started back in 2004. That's a pretty good ride. We really appreciate all of our members. 2020 was a very good year for EarningsBeats, in spite of everything going on around the world. Good year for the market as well. And here we are, predicted with everything going on, that the market would be as strong as it is. Well, I know that Tom has been right on spot on when it comes to the market. In spite of all the headlines and everything you hear, off to a really great start already, which is really terrific. I want to mention before I bring Tom in, there's a couple of events coming up that you could be interested in. Next week on Tuesday, I believe it is, it's our Max Payne webinar. That's a members only. We have two types of webinars. We have public webinars like today, where everybody's invited to join in. And we have members only webinars that are meant for our subscribers. Tuesday is one of those. The Max Payne webinar is when we take a look at options. We sort of a snapshot, 3 days ahead of the options expiration, and try to make some, predictions, or just maybe not predictions so much as just looking what the outstanding calls and puts in the major indexes and some stocks look like, and having some dialogue about where they might be headed into options expiration. Always an amazing event and with some amazing results. So that's coming up. Then the following week, we've got a couple of things going on. We've got our Q4 earnings sneak preview. That's open to the public, and you'll all hear about that. That's where we take a look at some of the key earnings that have occurred and some that are coming up. And it's really a sneak preview for the big event, which happens a week later, when we really dig into the earnings. By that time, a lot of companies will have reported, and will be able to, give some insight. And then finally, we'll have our ETF event on the 19th, which is our draft day, where Tom unveils the various ETFs in the new portfolio. Anyways, on that note, I want to see if Mr. Bowley's in the house and ready to go here.
I am. How are you doing, John?
I'm doing great. It's a beautiful sunny day here in Charleston. A little brisk, but no complaints. How about you?
Yeah, it's not bad. I mean, we were supposed to get some snow yesterday. I think Charlotte area got some, but I'm just over the South Carolina line, about 20 minutes south of Charlotte. And I think we got some flakes, but we didn't get anything that stuck. So I was able to get my Starbucks this morning.
I can't notice Starbucks. I think it's been doing pretty well, hasn't it, overall?
Starbucks?
Yeah.
Yeah, I think the stock's been doing well. I think everyone's, realizing that I'm still in my game, still going in on a regular basis. So
okay.
Stock's doing well.
All right, I'm going to step aside. I just wanted to mention, I know at some point, maybe early on, you can just let people know about, we always have a great webinar special for people taking the time to come in. Just want to make sure we get a chance to bring that up as well. But I'm going to step aside and let you get into the meat of things.
Yeah, I'll go ahead and I'll bring that up first, and then we'll get into the agenda, just so everyone has an idea of what we're planning and what we're doing here at EarningsBeats. So first things first, let me just let everyone know we do have a webinar special. Anytime we have webinars, we tend to give our members or prospective members an opportunity to come in at a discounted price. And so we're currently running a special. We're in the midst of raising our prices because we're adding quite a bit of service, especially surrounding the ETF service that we're offering. And so this is an opportunity really to lock in at the old price. After everything's up and running on our site, we're going to be switching our annual price to $997 a year. It's been $697. So we had a lot of members. Most of our members did take us up on an offer to extend for $697. You won't have to pay the higher price until you come up for renewal. So we thought with ETF still a little bit under construction, and we'll talk about that more throughout the session today. But we're still offering the $697 deal. So if you are new to EarningsBeats and you want to try our service, this is a great time to do it. We have a $7 fully refundable 30-day trial. So you sign up, you'll get charged $7, but we'll refund it to you. After 30 days, you can decide what you want to do. But if you come in over the next couple of days, you decide that you like what you see and you'd like to give our service a try, this is going to be a great time to go ahead and extend for the full year for the $697. We're going to have this through Monday. And that will enable you to enjoy all of our services, the stock service, the ETF, everything for the $697. And you won't have to worry about it until you come up with, for renewal. Also, if you're a new member, the 1 year will be added on to your 30-day free trial. So even though you may make a decision over the next couple of days, you'll still get the rest of your free trial, and then the 12 months will be added on. So I just want to make sure that's clear. But this is pretty good savings, $300 if you like the service, if you like what we talk about today, and you check out some of the things that we've done and that we're doing for our members. I think this is going to be a pretty good deal. So check this out. If you go into earningsbeats.com, at the top, you'll see webinar special. That's how you can get back to it even after today. It'll be up there for the next couple of days, so you can make sure you check this out. Let's go ahead and, Aaron, if you don't mind, pull up the agenda. I don't know if I need to give you the screen back. There we go. By the way, it's great to have Erin back. She was on maternity leave for a few months. I have an absolutely beautiful granddaughter. I'm so proud of her, so proud of Erin and her husband, Ty. She's back with us now full time, and it's great to have her. So, all right, okay, there we go. So here is the agenda. So today's webinar is really about building an ETF portfolio. Those of you who are familiar, who've been members of EarningsBeats, knows we've built some pretty good portfolios, but they've been stock portfolios. And there are a lot of investors that simply don't want to be in the stock market. They don't want to pick individual stocks. They want to get into ETFs. They prefer ETFs. Now, I wrote an article this morning, and sometimes I do have to chuckle because I've had people tell me, not folks here with EarningsBeats, but I've had people come up to me and talk to me about, I just don't trust the market. I don't want to be in individual stocks. I prefer ETFs. And I'm just sitting there thinking, okay, well, depending on the ETFs you own, you probably own stocks. An ETF is just a basket of stocks. So you own stocks. The difference is that you're not picking them. Somebody else is picking them for you. So I'm still a big proponent of putting together my own stock portfolio because I can hand select all the stocks that go into it. And with no commissions, it makes perfect sense to do that because there's no cost. So if you want to get in, get out, whatever, there's no cost involved whatsoever. With an ETF, there are expenses associated. So you've got somebody else picking your stocks, some of which you probably don't even like, and it's widely diversified. And those of you who know me well, I'm not a fan of diversification. I think it cuts your returns more than anything. It's just bringing you back to the middle, and I believe you can outperform. So diversification to me is not something I really think about very often. But I get it. If you're, if you want to be in the market, but you don't want to watch it every day and you want to participate in an advance, hey, ETFs is better than leaving your money sitting in cash. There's no doubt about it. You want to be involved. I believe the stock market's going higher, and we're going to talk about that in just a minute. So the agenda for today, as you can see on your screen, I'm kind of giving you a quick introduction. I'm going to talk just for a few minutes about the secular bull market, because I think before you do anything in stocks, you've got to take a look at the big picture. You have to be comfortable with what you think the stock market's going to do. If I was sitting here saying it looks like we're in a bear market, the last thing I'd want to be doing is putting my money into ETFs and stocks to ride the bear market down. I would either want to short, or I'd want to be in cash, or I'd want to pick my spots to be long, but I don't want to just buy and hold, not during a bear market. So that's really the first step for me, is looking to see what kind of market are we in. So we'll do that. Then we'll get into relative strength. Relative strength is at the core of just about everything we do at EarningsBeats. So I think it's really important to take a quick look there. Coming soon, this is going to be a new ETF portfolio that we haven't announced yet. And that's the sector allocation ETF portfolio. It's just going to focus on the 11 sector ETFs. That's all that's going to be owned. And they're going to be owned in different amounts based on momentum and relative strength, those two criteria. I was hoping it was going to be ready to announce today. I'm not quite there yet. Still running some tests to see, trying to get the timing down a little bit better. But hopefully should be by the end of the month, we'll begin our sector allocation ETF portfolio. Then we're going to get into selecting ETFs for our model ETF portfolio. This is one that is in play right now. We began our model ETF portfolio on October 19th. It has been fantastic. I was hoping maybe we could outperform by a little bit. The S&P, we're already up over 4 basis points, 4 percentage points above the S&P 500. So the S&P 500, I think, is up like 11.6% since October 19th. And our model portfolio is up 15.7% or something like that. It's about little over 4 percentage points higher, which that's not easy to do when you're looking at a portfolio of literally hundreds of stocks. Trying to outperform a diversified S&P 500 with a diversified portfolio is not easy to do, but we have managed to do it. We're going to talk a little bit about that. We'll go into the strong ETF ChartList. As far as our ETF service goes, I think that's our flagship ChartList, where we look at relative strength to identify some of the best ETFs out there, and we make those available for our members. And starting today, our members are going to be able to download an EB ETF Analyzer. It's a new spreadsheet that we've developed where you can go in and pick your own ETFs, and basically we'll spit out what you own, because I think that's really important, knowing what you own. When I talk about ETFs, you just got to know what you own. Don't just buy an ETF because it's gone up the last 3 months. I mean, if you don't know what that ETF is invested in, or if you've got 10 ETFs and you don't know what the combination of all these ETFs represent in your portfolio, I think you're taking probably more risk than if you were in individual stocks. So we're going to talk about all that, and then we'll wrap up with the model ETF portfolio draft, which is upcoming. So we'll talk just a couple minutes about that. All right, so let's go ahead and get this thing started. I'm going to get into the secular bull market. So let me get my screen up. And actually, before I even get into that, I always start my shows with something. And if you watch the shows, you'll be familiar with this. Okay, so here you can see our homepage. And obviously, anyone can come in and sign up for our free newsletter. Those of you that are here today are either coming in from our paid membership, our free membership at EarningsBeats Digest, or you're coming in directly from one of the articles where we just published the room link, either in Chart Watchers or in my Trading Places blog this morning. If you're not already a free EarningsBeats Digest subscriber, we will add you. Based on being in here, you've become part of our community. We'll add you to that newsletter. You can unsubscribe at any time. If you want to unsubscribe tomorrow, do it. But I think you're going to enjoy our newsletter. I think it'll give you some really good trading opportunities. I think it gives you great information about the market, how we approach the market, and so forth. Comes out Mondays, Wednesdays, and Friday mornings. Again, no credit card required, and you can unsubscribe at any time. So I want to make sure everyone's aware of that. In case you see an email, Monday morning and you're like, hey, I didn't sign up for it. Well, coming in here, essentially you become part of our community. So we'll get you signed up. If you don't want it, you can unsubscribe, like I said, at any time. Over on the right side, you'll see our stock portfolio performance. And I'm going to mention this because this is pretty critical, even if you're looking at ETFs. You want to look for relative strength, and you also want to know the stocks that are in your ETFs. And so one of the things that we do with the analyzer, the ETF analyzer, is we let you know if some of our portfolio stocks are in the ETFs that you own, at least if they're among the top holdings. And I think that will at least give you maybe a little bit more confidence that, hey, if 3 of the top 10 holdings are also in the EB portfolios, then at least I have a pretty good sense that these are strong relative performers. But if you look at the performance in these portfolios and you think that just getting into a diversified S&P 500 is the way to go, I would argue that. These numbers, all of our portfolios have been announced in real time to our members. We have members writing us saying, we've never seen these kinds of returns before. We have portfolio managers that have talked to me, been on the phone with me and said, this is unbelievable. I've never, in all the years I've been doing this, I've never seen anything like this. Look at the since inception returns of the model portfolio, 225% since November 19th, 2018. The S&P, I mean, we've been going up 42%, but this is two-pronged. Number one, you can look back in hindsight and say, yeah, we're up 42% over the last 2 years, but you would have to have gone through the trade war and a pandemic holding throughout the whole thing to achieve that 42%. And I think everyone realizes with all the news that was coming out over the last couple of years and all the negativity, just staying in the market was a problem. Forget about what you're picking, but just being in it was not easy. We have consistently been bullish throughout this entire period, and I think the stock market's going a lot higher, and I mean a lot higher. We'll talk about that in just a second. But 42% since inception. Look at the model portfolio, 225%. Do you think that makes a difference in your financial future? In a little over 2 years, 183% outperformance. That's pretty impressive. If you look at our others, which these portfolios were announced more recently, so the aggressive now has been out about a year and a half, 33.75% on the S&P, 85% on our aggressive portfolio. Strong AD, 31% since May of 2020, right in the middle of the pandemic. We came out with a portfolio based on the accumulation distribution lines. That's what this AD means, strong accumulation distribution portfolio. Stocks meeting our criteria in this portfolio up 88% since May 19th. Most people didn't even want to see the stock market. We're up 88% relative to the 31% on the S&P. I'm just pointing this out because I think a lot of this you can take in building an ETF portfolio. You still want to look for relative strength. You still want to know what is in these portfolios, and you want to be comfortable owning them. Now, all of the portfolio or all of the ETFs are going to have, many of them have, anywhere from dozens of stocks to maybe hundreds of stocks, literally. And so you've got to be comfortable with that kind of diversification. Again, if you get that many stocks in your portfolio by using ETFs, you're going to have a lot of underperforming stocks. And so you just have to be comfortable with that. And if that's your style and you're comfortable and that's what you want to do, that's fine. But there's still ways to make sure that your ETFs are performing better than the S&P 500. And that's what we want to talk about a little bit today. All right, so let's go ahead and move on to this secular bull market. I want to talk a little bit about this. So again, if you're familiar with me, you're familiar with EarningsBeats, you've seen this chart before. We are in a secular bull market. That doesn't mean that we can't go down from time to time. We saw it with the pandemic. We saw it back in 2015, 2016. That was a pretty, difficult period. Maybe it's far enough back that we don't remember it, but from 2014 to 2016, we had a lot of sideways action, a lot of big drops followed by recoveries, but we went sideways in here, but it was all part of a secular bull market. The secular bull market, I mean, just think of it like a jet stream. The jet stream here in the US moves from west to east. If you get in a plane and you go west to east, your trip might take 4.5 hours. If you go east to west, it might take 5.5 hours. It's because the jet stream will move you faster. Well, in a secular bull market, think of it like a jet stream. We are going higher. The market's going higher. We've been through a pandemic. We've been through a trade war, and we're sitting at all-time highs. And most folks are just sitting back, scratching their heads saying, this can't be. We can't go any higher. This market's way overpriced. We're way overvalued. I saw someone, a recognizable portfolio manager who's been doing this for many years, said this is the biggest bubble of his lifetime. And I read the article just to see what the reasoning was, and two reasons, primary reasons that were given. One was that PE ratios are too high. PE ratios are, at or near all-time highs. Well, I was a practicing CPA. I did valuations. One thing that's really important in valuations is interest rates. Because when interest rates are high, you have alternatives besides buying a company based on its earnings or future earnings. You might be willing to pay 12 times, 10 times earnings based on higher interest rates, because you have to think about your risk. If I can go out and get a 10-year treasury for 7%, then I'm not going to be willing to pay a lot of money to try to get 12% on earnings growth in a company. But we're in a market environment right now with interest rates at 1%. What is your alternative to investing in the stock market? That's what's driving PE ratios. When companies are growing their earnings rapidly with a 1% 10-year treasury yield, those earnings are incredibly valuable. I think we're going to see growth over the next several years, and it's going to come with very low interest rates, and that growth is going to be extremely valuable. We're already seeing it. So if you want to sit back and look at PE ratios, go right ahead. No, thank you for me. I think that we are in a completely different environment. Interest rates are near all-time lows, and I think companies that can grow their earnings are going to continue to be rewarded. Look at Tesla. Tesla isn't going up just because it's got this great fundamental balance sheet. In fact, anybody looking at their balance sheet would probably say there's no way I would ever touch Tesla. And I saw Bill Miller, famed portfolio manager, just came out recently and said his biggest mistake was not owning Tesla. Well, Tesla's been on our radar for quite a while. I've written about it. We've had it in our portfolios last 4 quarters. You can't not own Tesla when the market is beating you over the head to own Tesla. Their earnings growth and they're beating estimates by a wide margin, and their growth is exploding. That's what's driving their valuations, not their balance sheet. Now, if Tesla comes out and says, well, competition's picked up and we see our growth slowing, get out. That will be the time to get out. But right now, your foot should be on the pedal down to the floorboard with Tesla. And that's been a great performer for us in our portfolios, especially the model portfolio. But anyway, looking at this chart, here's your secular bull market. Oh, the other thing the manager said in addition to PEs was he's like, look where we were back in 2009 and where we are now. So 666 up to 3,800 now. So that's 5 or 6 times. So it's impossible. We can't go any higher. Well, I still think we're maybe in the third inning probably of this secular bull market. And somebody could have made the same point back here in 1988, 1989. We were probably sitting at about, 350. And if you look back to the low in 1974, which was down, 60, it was like 6 times. We'd gone up about 6 times. Here, probably about 6 times. Same thing. 74 to 88 or 89, that's 15 years. 2009 to 21, okay, 12 years. Maybe we did a little bit faster here. But look what happened after. We actually accelerated to the upside. Don't believe, I think that's one of the biggest mistakes investors make. It's one of the biggest mistakes I made throughout much of my career, is when the market goes up, you think it can't go any higher. It just can't. You know, we've never been here before. This is an all-time high. We need to pull back to 2,500. Good luck. I mean, I don't think we're going to see 2,500. I think that low that we saw back in March, you will never again see in your lifetime. That's a bold statement, but I don't believe you'll ever see it in your lifetime. Any of our lifetimes. Secular bear markets, you got to be careful. You can see the red shaded areas. That's where we just go nowhere for 12, 13 years. But these secular bull markets, when we're moving, you want to be in them. But you don't just want to be in them. You want to be in leading stocks. If you're in them, that's great. I mean, if you're making 13% a year, there's nothing wrong with that. But how about if you make 20% a year, or 30, or 50? Or our model portfolio has gone up 100% now 2 years in a row. You know, we're not registered investment advisors, and I always like to throw this out there because past performance doesn't guarantee future results. I don't know what the future holds, but what I do know is what I believe, which is that the stock market's going to go higher, and I think leading stocks and leading industry groups are going to outperform the S&P 500. And that's been the theme that's driven us for the past couple of years with these portfolios. I try not to listen to the noise, the media, the hype, and I just follow what the charts are telling me. And I think we've got some pretty good stuff coming forward. Now, back last year, I said we're in a secular bull market, but there are a couple things that we need to watch for. That would really confirm it for me that this market's going a lot higher. The first is the money rotation coming from treasuries. Notice throughout the last 10, 12 years, every time we get into a period where the 10-year treasury yield is rising, stocks tend to do really well. And that's because when treasury yields are rising, money's coming out of treasuries. Always. It's always that 100% inverse relationship. So if you see the yield going up, that means folks are selling treasuries. Well, what are they doing with their proceeds? Rotating it right into equities. And you can see this last move here to the upside, look what it's doing to the move to the upside. Now, when you look at a secular bear market, the difference between a secular bear market is you'll still go up when the yields go up, but when the yields come down, the stock market gets hammered. Because when yields are coming down, that means money's rotating into treasuries and coming out of the stock market. But during a secular bull market, notice these downtrends in the 10-year treasury yield. They may slow the pace of the move to the upside in the S&P, but they don't. You know, right here was a pretty big example of 2015 and 2016. We just went sideways for a year while the yield was going down. Why? New money was coming in. In a secular bull market, you've always got new money coming in. So this was one thing I was looking for because I was being asked, what could drive, what's the catalyst for the stock market to go up? My answer, rotation out of the treasury market. Do you want 1% in the treasury market, or do you want earnings growth on some of these companies of 30, 40, 60%, and the valuations that are resulting from that growth in a low interest rate environment? Your choice. Do you want 1% guaranteed, or do you want to take some risk and ride this market to the upside? And I think it's an easy choice when you only have 1% as your alternative. So to me, that's what's going to continue to drive the market. Now, I don't think interest rates are going to go shooting higher. Do I think over the next few years we could get back up 2-3%? Yeah, I think we could. And that would drive the stock market crazy to the upside. And you might think, well, rising interest rates aren't good for the market. Well, rising interest rates when you get too high are not good for the market. 2 or 3% on the 10-year treasury yield, that's historically low. So we've got plenty of room to the upside in the yield, especially if growth is strong, yields, moving up from 1 to 2 or 3% are going to have almost no impact. Don't worry about interest rates. Next up, transports. This was another key. Most of you probably heard about the Dow theory. And essentially when transports are going up to confirm the Dow, when you've got the Dow Jones transportation average going up to confirm the Dow Jones industrial average or vice versa, that's a very bullish confirmation for the market. Well, when you look at this chart, excuse me, I want you to focus on the periods when transports are going up. Here, transports are going up. Look at the move in the S&P 500 in a 2-year period when transports went up. Here, transport's mostly sideways, or excuse me, transport's down here, mostly sideways. S&P does almost nothing. Then transports break out, another big move. S&P up 47%. Then transports go into a spin to the downside. S&P goes nowhere. Wait, here's another breakout in the transports. S&P 500, another big move to the upside. Then we go down here. We have a little trouble with the transports. And up the top, you can see the S&P 500, much more volatile, struggles. Now look at where we are. Transport's just making the breakout over this prior high. I don't know where they're going, how high they're going to go. But when they go up, look at what the S&P 500 is doing. I mean, I'm not making this up. This is all, and I owe a lot of this to John Murphy. That's where I got a lot of my intermarket, relationship analysis skills. And I've taken those skills and I do a lot more research. I like to analyze the market. I like to figure out what makes it tick. And one of the things that makes it tick is a moving transport average to the upside. That usually results in big moves in the S&P 500. And we're in the midst of that. So you've got money rotating out of treasuries, billions of dollars coming out of treasuries. I mean, my gosh, the money, if ever there was a bubble in something, it was probably the bond market. You've got global markets where they pay you, or excuse me, you pay them. You have negative interest rates, which that just kind of blows my mind. Here, hold my money and I'll pay you to do it. I'd rather put it under a cushion or under my mattress. But anyway, that's where the bubble is, not in the stock market. One more chart I'll show you. XLY versus XLP, consumer discretionary versus consumer staples. We're breaking out to new highs. Why in the heck, if we were topping, would Wall Street be putting their money hand over fist? And that's what this means. When you're going straight up, it is money rotating heavily into consumer discretionary stocks. Consumer discretionary companies sell us the things we want, not the things we need. When do we spend money on the things we want? We spend money on the things we want when we feel good about the economy. We feel good about our jobs. We just feel good. When the XLY is outperforming the XLP, it almost always coincides with the S&P 500 moving higher. Almost always. Here's the correlation down here at the bottom. This is going back the last decade. This is the correlation, XLY versus XLP, the direction of that ratio versus the direction of the S&P 500. The blue shaded area shows you positive correlation of 0.5 to 1.0. That's very, very strong correlation. Anything above 0 is positive correlation. But when you get up to 0.5 and especially closer to 1, that's hand in hand correlation. Now look down at the bottom here. The lowest we've ever gotten was one time back in 2017 at minus 0.50. And we've had few trips below 0. This is a very strong indicator on which way the stock market is going. And look at that ratio. Wall Street doesn't pour their money into consumer discretionary stocks right before a bear market. So you have to understand what the market is telling us. The market is telling us we are in a runaway secular bull market. And to be anywhere else, I don't know where I would want to be. One thing I will say is the international stocks are looking much better relative to the S&P than they used to. I mean, the S&P was the clear leader around the globe. I think you can invest just about anywhere around the world right now. I might be a little bit more concerned with China. But other than that, I would say most markets around the globe look pretty good over the long term, and I think we're going higher. All right. So anyway, that was the the bull market. I want to talk a little bit about relative strength, and then we'll get into some of the more ETF related topics. Tesla, I mentioned earlier, and I get emails almost daily, certainly weekly, from members or prospective members saying Tesla can't keep going up, just can't happen. I remember when it went up right here, back when it announced that it was going to be added to the S&P. I had a lot of members back then saying, is this the time to get out? We just got a nice pop. And the answer is no. I mean, if you look at this chart, first of all, look at the AD line. that can't be much stronger. That's telling me, beating me over the head, that institutions are likely accumulating Tesla. And you can sit back and wonder why. I did that. I made that mistake with Amazon. I would not buy Amazon. Just my background, I guess, as a CPA and looking at the fundamentals. They never reported earnings, and their market valuation was just crazy. I kept looking at it and I just can't believe. I mean, all these people were wrong. The market's wrong. I was wrong. Market wasn't wrong. Market got it right. I wish I had listened to the market. Well, the market's telling you about Tesla right now. You can argue with it all you want, but, and Tesla was, I haven't looked recently, but in terms of dollars, Tesla was the most heavily shorted stock. 6 months ago, it was the most heavily shorted stock. I don't know if it still is. If it is, there's some people that they got a very high tolerance of pain to ride this on the short side, because Tesla was $400 pre-split a year ago, 13 months ago. 400. Now it is at 880, and it's split 5-for-1. So that's 4,400. Anybody that's a member of EarningsBeats knows is when we've gone through these recent draft days for our portfolios, I've been extremely high on Tesla. This isn't something I'm looking back and saying, yeah, it's been a great performer. Or it's not like window dressing like many of the portfolio managers do. They buy it at the end of the quarter to make them look brilliant. This is a stock that we've talked about and that we've had in our portfolio now for 4 straight quarters. We've had it the whole time. And it's obviously been one of the big reasons why our portfolios have done as well as they have. At some point, Tesla is going to be overpriced, overvalued. The market's going to correct, or this stock is going to correct, and it'll be time to exit. But for now, I mean, look at the autos. Autos are the best performing industry group, by the way, and Tesla is the best performing auto company. I mean, I don't know how you can invest in a better stock. Now, timing wise, would I jump in right here after going up 6, 7, 8, 10 days in a row or whatever it's done? No. I mean, the best time to enter these stocks is when they pull back, test key support levels, maybe moving averages, and so forth. But if you're in it, I wouldn't personally be trading. Just hold. Just let it go. And that's how you make big returns, and that's how you outperform by a wide margin. But Tesla, you can see, versus the autos breaking to new highs. This is what we look for in terms of relative strength. The group going higher, the stock relative to its peer group going higher, the stock relative to the S&P going higher, and the peer group relative to the S&P going higher. It doesn't get any better than Tesla. Again, that'll change at some point, but while it's a leader, we want to own it. Roku is another stock that we added in the November quarter, back here. And you can see AD line was strengthening, had been strengthening for a few months. Relative to computer hardware, it was moving up, and it had reached in November, by the time we picked it, it had already broken to about a 52-week relative high to its computer hardware peers. Roku relative to the S&P going up, and then computer hardware, after a huge run over the summer, it pulled back a little bit, but I still think it's fine relative to the S&P. So you got a strong group, and you got one of the best performing stocks in that group, up 56% since November 19th. Tesla, 75% since November 19th. You have 2 of those stocks in your portfolio, and you're probably going to have a pretty good quarter. Now, as far as our ETFs go, here are our 2 best performers. Now, this is a first quarter of our strong ETF, our model ETF portfolio. And the way we did it, we put 8 ETFs in, and we weighted them differently, and I'll tell you why in just a bit. But our weighting of the Amplify Online Retail ETF, this was our highest weighting. We actually had 20% of our portfolio in the Amplify Online Retail ETF, IBUI. And since October 19th, that was the date that we announced our portfolios, or our model ETF portfolio. Since that date, this is up 23.96%. And we weighted it this way. I mean, first of all, look at the iBuy relative to the S&P 500. It's been a major outperformer. And personally, I happen to like online retail, especially with a pandemic. So I wanted to have pretty good exposure here. Now, you could be a tremendous risk taker and put 100% in here and just have all your eggs in one basket. We wanted to be a little bit more conservative than that. But it was our highest weighted ETF and has helped us beat the S&P 500. Like I said, 23.96% since October 19th. The S&P 500 is 11 point something. So we've essentially, that 20% of our portfolio has doubled the S&P 500. And so that's one of the big reasons why we're up more than 4 percentage points over the S&P. The other one that's done incredibly well, it was volatile going in. We knew it would be volatile. So we wanted a piece of it, but we didn't want to go crazy because if we were wrong, this is one that could drop pretty fast. But this is the Invesco Wilder Hill Clean Energy ETF, PBW. So we got in here October 19th. And once again, on a relative basis, you can see it's a leader. And but we only put 5% in this one. This was our smallest weighting. And just because it was very concentrated, a lot of solar names. And this is a group that can do extremely well, or it can do extremely poorly. And sometimes it happens pretty quickly. So again, that's why only the 5%. Now, yeah, we'd have been a genius if we had said put 100% in. But again, how much risk do you want to take? Because that would have been extremely risky. And look at right after October 19th. I mean, we were down on this more than 10% in less than 2 weeks. So that wouldn't have felt very good if we were sitting in 100%. But being in 5% didn't really hurt us that badly. But when you get this kind of a gain, I mean, from 60 something to 120 and change, from that low, it's doubled. And from the time we got in October 19th, it's up 75%. So having just 5% turned out to be a pretty smart move. I bring these up because this is what drives our portfolios, either stock or the model ETF portfolio. We want to be where the strength is, the relative strength is, and where the momentum is. Keep in mind, we're not getting in these portfolios with the idea we're going to hold them for 6 years or 20 years. We're getting in with the idea we're holding them 3 months. We want to be in what's working in the market. Okay, so that's really important. All right, now before I get into the sector ETF allocation portfolio, which is coming soon, for those of you maybe who came in a little late, I do want to just mention, if you go to EarningsBeats, you can click up here at the top, webinar special. We're running a special right now. Our entire service, we were raising the price from $697 to $997 effective January 1st, but we recognize some of our ETF service still under construction. So we are allowing anyone right now to sign up for $697, the old price, and that will include everything, including stock service, the ETF service, everything that we offer at EarningsBeats. You can get for $697. You won't have to worry about the higher price until that annual membership expires when you go to renew. So you can get 12 months right now at a very, very heavily reduced price. And I just want to point it out. So again, you could save an additional $300 right now by doing this. If you're not currently a member, this is what I would suggest you do. Sign up for our free trial. You pay $7, but we refund it to you within a week. So when you use your credit card, you pay the $7, we refund it. At the end of 30 days, if you don't like the service, just cancel, you're gone, no charge. But if you do like the service, especially over the next couple of days, if you're looking at it, you think, hey, this is something that I think will really be good for me, I'd like to try it. We will tack on the 12 months to the end of your trial. So if you're on a trial and you're like, well, I don't want to really give up the last 28 days, you're not giving it up. We'll add that 1 year on to your trial expiration. So you'll technically get 13 months. Anyhow, just wanted to mention that for anybody who came in late. So let's talk a little bit about this sector ETF allocation portfolio, which is going to be coming out soon. I've been working on this. I was trying to work on it over the holidays to have it ready. I do want to give a shout out to Matt Townsend, who we hired last year, and to Erin, my daughter, who was hired in 2019. They've both been working with me on this project. And, you know, I think this is going to be a really important piece of anyone's portfolio if you like ETFs. Because what we're going to do, especially if you go back to the beginning when I was talking about this being a secular bull market, in a secular bull market, you want to be in the sectors that are driving the secular bull market. And as it rotates and as momentum strengthens or weakens, you want to adjust your holdings accordingly. And so that's going to be the whole point of this sector allocation ETF portfolio, is to be a part of the groups that are leading the secular bull market higher. So the goal there is absolutely to beat the S&P 500. If it's not, we're doing something wrong. We'll need to change the formula. But the formula itself, while I don't have it completely figured out, it's going to be based really kind of two prongs. Number one, it's going to be looking at this relative PPO. So this chart that you're looking at right here is technology relative to the S&P 500. So this is a 3-year weekly chart. Here is the relative price action. Relative price action. This doesn't mean technology is going up. It means technology is outperforming the S&P 500. Clearly, I think you could see that if you were in the XLK, whatever investment was in the XLK for the last 3 years, or actually this is a 2-year chart. I'm sorry. I said 3 years. It's 2 years. But any money that you would have had in the XLK the last 2 years obviously would have beaten the S&P 500. And that's what happens in secular bull markets. You want to be in those aggressive areas primarily. But you go through periods where the momentum is strengthening. You go through periods where the momentum is weakening. And so looking at that is all going to be a part of figuring out how much to put into each one of the portfolios, or in each one of the ETFs. Now, I can tell you I'm a fan if the weekly PPO is above 0. If the weekly PPO is not above 0, you've still got your short-term relative moving average below your longer-term relative moving average. So you might be seeing some improving strength in those areas, but you still haven't seen enough strength, relative strength, to get above 0. Look at, here we went above 0 back in February of 2019, and we haven't gone below that center line since. That's definitely a reason to want to be in any ETF or any stock. I mean, if the PPO is positive, it's generally telling you that momentum is strong. If the relative PPO is above 0, it's telling you that you've got a relative winner versus the S&P 500. So that will be part of the formula. Also, I'm looking at rate of change as part of the formula as well, so that when a group is above the 0 line and starts to strengthen, that's really when we want to make sure that we have a higher percentage. But the goal here is to essentially look at all 11 of these sector ETFs. Here's consumer discretionary. So you can see here we went negative for a while. We underperformed on a relative basis. But when we started strengthening and got above the 0 line, which was right in here, this has been a great area. If you had gotten into, if you had started upping your percentage of the XLY when you broke that 0 line, right here, this is the absolute chart of the consumer discretionary group. Look at that move that it's made. Look at the relative move that it's made. It's been one of the strongest areas of the market. And so, again, that's an area that you certainly would want to begin overweighting as it's moving up. This sector allocation ETF portfolio will be a mechanical formula. I'm not going to say, oh, I like this group or I don't like this group. It's literally the percentages are all going to be based on a mathematical formula. So if that's something that interests you, this will be another product that will be coming out soon. Hopefully by the end of the month. It should be out by the end of January. And then, we can go right through the list. You can see all of these. These are the aggressive. First 5 are all aggressive. Industrials have been strengthening. They've pulled back the last 45 days. I think we're going to turn back up again. They're still well above the 0 line on the PPO, relative PPO, so they look good. Financials with the 10-year treasury yield moving up. Look at financials all of a sudden taking center stage, moving above 0. So if I was getting in, if I was establishing this portfolio, right now, I'd absolutely at least want a piece of financials based on this. Healthcare is below. Look at this, it's been below. So staying out of healthcare since the early part of August makes sense because we keep downtrending versus the S&P 500. So you can kind of see how this works. All right, anyway, that's coming soon to an EarningsBeats page near you. Next up, selecting ETFs. The first thing I want to do is I just want to talk about our strong ETF portfolio, or a strong ETF chart list, I should say. And trying to think, maybe I didn't download it on this account. I've got it on my other account. Oh, there it is. I don't know if it's the latest one. Let me see if this is the latest one. No, it is not. So that means you all get to see how you can do this because I'm going to update it right now. So let's go to ETF chart lists. All right, so under ETF chart list, this is what our members are able to do. If you need to be at least an extra member at Stock Charts. You can view these charts in our chart lists. If you're not a Stock Charts member, you can view them one at a time. But in order to be able to download them into your account and to be able to sort and scan and do all kinds of things, you need to be at least an extra member. I would highly recommend it. I think it'll be well worth, I think it's $25 a month or something to have the extra membership. But anyway, the strong ETF chart list, all you have to do is you go in, you copy the password, you click on this. Oh, it didn't come up. Maybe I did download it somewhere into the account. But anyway, I'm gonna go ahead and download it again. When it comes up, it'll prompt you for a password. You just paste the password in, and then it'll bring you to this. If you're a Stock Charts member. If you're not a member, you won't have this Save to Chart List button, and you'll probably see ads because they're going to want you to sign up. But if you're already a member, you don't see the ads, and you can just save to chart list. So I'm going to say replace chart list, and I'm going to go down to this strong, where did I have that? Strong ETF chart list right here. And save results. Just like that, done. So now it's in the account. So let me go now back over to, oops, we'll get to that in just a bit. So now let me go back over here. And now we got 70 in here. So now just updated it. So I've got the strong ETF chart list. Now, the way we come up with this chart list, we're going to update this once a month for our members. So at the end of every month, hopefully the first day or two of the calendar month, you'll have this new updated strong ETF chart list. And essentially what this is it's going to be the highest scooter scores among ETFs. So scooters is a measure of relative strength. So we're going to be using that as our measure to make sure that we're getting the ETFs that are performing the best. Then we want to make sure the PPOs are at least 1. I showed you PPOs. Well, a lot of ETFs are going to be above 0. If you get above 1, then you're starting to show even more momentum. So we're going to get the best of the best in terms of relative strength, and then we're going to get the best of the best in terms of momentum. We're going to get rid of foreign ETFs. That's not my expertise. That's not to say that there aren't some great foreign ETFs and that there aren't some great foreign stocks. If you want to, delve into that, by all means, have at it. But we can only specialize in so many things, and trying to get into all the different areas of the world is a task that honestly is just too big of a task to try to get into. And also you've got, different, government, setups and rules, and, there's just so many things to be aware of in various countries and so forth. So I'll leave that to other folks. Look for ETFs that specialize in foreign markets. That would be my suggestion. But we eliminate those for our purposes. We also eliminate leveraged ETFs. So if you're somebody who wants the 3 times You know, you're looking at the solar ETFs and you want to get 3 times because that 75% in 2 months isn't good enough. Feel free, but we're not going to do that. Again, we're trying to be somewhat reasonable here in our selections. Not to say that most aggressive ETF traders can't use those. It's just not what we're going to have in our strong earnings chart list. And then finally, we're going to try to eliminate illiquid ETFs. So ETFs that don't trade a lot of volume. Normally, I think we're going to look for at least 100,000 shares a day. And then also illiquidity relates to stocks that are within an ETF. If an ETF owns a bunch of illiquid stocks, I'm not so sure I'd be comfortable owning it. Now, you might see 1 or 2 that we have on our list that maybe has a mixture of some illiquid with more liquid. You know, and I'll talk about that when I go over the spreadsheet in just a few minutes. But this is how we're putting these chart lists together. So the strong ETF chart list that you see is going to be based on this. So, and then you can, you know, go through and pull these up if you want. Take a look. Obviously, you're going to see a lot of strength in many of these. You can also, from the chart list, go through the summary here. And you might say, well, you know, I want to know what's really working over the last week. Well, pull up 1 week and you can see clean edge, green energy, clean energy, clean energy, clean energy, solar. I think probably you're getting a pretty good sense of what worked last week. You know, so you could do a week if you wanted to say, okay, well, how about the last month? Solar, clean energy, energy, you know, these stocks have done well. So they've done well not only in our model ETF portfolio, but we've got 2 of them that have done exceptionally well in our stock portfolios as well. We've got Enphase, ENPH, and SunPower, SPWR. Both of those stocks have just soared in our portfolios. So that's in addition to stocks, you know, that we talked about earlier, like Tesla, Roku. We go with leaders and we go with stocks that are outperforming. And every 90 days, we switch them out. That's what we do with our ETF portfolio. And that's what we do with our stock portfolios. All right, so let's move on now to the strong ETF chart list and the ETF analyzer. We just talked a little bit about this chart list. So I'm now going to pull up this ETF analyzer. And this is, again, a lot of help. I got a lot of help from Matt Townsend, who is helping me develop some of our products at EarningsBeats. And also Erin, my daughter, who helped me with the Excel spreadsheet quite a bit because she quite frankly, is just smarter than I am on Excel. I used to think I was smart until I saw all of her spreadsheets. And then it's like, okay, I'm not nearly as smart. We've also had some members. By the way, I want to thank our members who have sent stuff in, some Excel gurus. Sometimes I pull up the spreadsheet and I'm like, okay, I don't even know how these got created. But I do enjoy, you know, having those sent in. I can't promise you I'm going to look at them quickly because we have so much going on at EarningsBeats. It's just hard to get the time to look at it, but I do really appreciate those who have taken the time to do your own research and send it to me. That's been awesome. I encourage anybody who does that, send it to me. I'd love to follow it. If we ever use it, I promise you I'll give you credit for it. And get your permission, by the way, as well. But this spreadsheet that Aaron put together, what we've done is we've taken all of those strong ETFs that you just saw on the chart list, and we put them on an Excel spreadsheet. So here's ETF number 1. Remember, there were 70 of them. If you go over here, and we put this in edit mode, see how we've got 70 of them? All right. Well, if you come back over here from cell 14, it should go down to 83 would be 70. And it'll take us, we got them numbered there, and there it is, down to line 8370. So there are your 70 strong ETF chart lists, ETFs right here. Now, what we've done is, I'll show you a different spreadsheet in a minute, but the top 10 holdings of each one of these ETFs is listed here. So if you see something that's really low, like this one, 3.96, if the top 10 holdings only account for 3.96%, you can be really certain that this is a widely diversified ETF with hundreds and hundreds of stocks. So if you're somebody who's looking for a lot of diversification, that is an ETF that you might be very interested in. And I'll give you some different examples of how you might put these together in just a minute. But if you get into an ETF that has a high percentage, like this one, Fidelity MSCI Consumer Discretionary Index, 63% of the entire ETF is in 10 stocks. You might want to take a look at those 10 stocks and make sure you like them before you buy the FDIS ETF, right? The other thing is 94%. I mean, it says it's Consumer Discretionary Index. 94%, that's the other thing that we put in here for you, is we're giving you the breakdown. So for FDIS, only 0.5% is in technology stocks. 94% is consumer discretionary. Consumer staple is almost 5%. And then if you come all the way across, you'll see that we make sure they total 100%. So that's kind of our audit to make sure that we've got the numbers in there correctly. You'll see that 100% all the way down. So we got the numbers. So unless we made a mistake where we inflated one number and underinflated the other by the exact same percentage, which I find probably not likely to occur, we've got all this input for you. Okay. Now, the cool thing about this spreadsheet is that you can go through and decide how much percentage you want to put into each one. So let's say you are looking for widely diversified ETFs, and you're going to look for anything that top 10 holdings is under 5%. And there's a bunch of them on here. I'm going to pick 5 of them and just show you how this ETF works. So let's put 20%. You can put your percentage in, put 20% here. I'll go down here. Let me find another one. Here's the mid cap 400. Let's put 20% in here. Small cap, mid cap. SPDR S&P 1000. Let's put 20% in here. Most of these are small. We'll pick, I don't know, let's do biotech. Why not? Well, no, I don't want to get into that. Let's trying to see. Let's do 20% of this high beta. And so we need one more 20%. Let's say leisure and entertainment. Just for whatever reason, that's the group that you think is going to do really well. So when you put all these in, first of all, this will come up error unless you total 100%. So this I totaled everything I put in here. My 520% equals 100%. So this says no error. If I change this to 19%, we got an error. We've only accounted for 99%. Okay, so there's your 20. Put your 20 in. No error. And these blue cells, by the way, are blue-gray cells. These are member input cells. Everything else is locked. So you're not going to be able to input anything else. But you can, if you wanted to add ETFs that we don't have, if you say, you know what, there's still this other ETF that I really want to add, you can go in and put these into these blank areas. Just make sure that you go find the percentage. You can go to Yahoo Finance. That'll give you sector holdings. Put in your percentages. Make sure they add to 100. Put your percentage in, and you can still make that apart. So it's not just our ETFs. If you want to add some, you can. But once you do this, look at what happens. It gives you your allocation by sector. So here's the S&P 500. And then here's your allocation. So again, this gets back to our principle of know what you own. Don't just stand around the water cooler. Of course, most people are social distancing, so you're probably not standing around the water cooler anymore. But don't just take ETFs and say, well, it's done well. Here's the 5 ETFs I want to own. How do you even know what you own? I mean, some of these, maybe you know by their name, like the one I put in here, or the one I looked at, the FDIS. I mean, if it says it's consumer discretionary ETF, chances are the majority of it's going to be in consumer discretionary. But you might be surprised, some of these, their ownership in various ETFs. So now you've got the results. These are the 5 funds you're looking at. And you're like, okay, is this what I want? You know, I've got the, where was it? Let's go back over here for a second. And I'm going to bring up that the Actually, it's up here further. I'm going to bring up that relative strength if I can find it. There it is. All right, I might look at this, and this is how I do the model ETF portfolio. I'm telling you exactly what I do. I might look at this and say, end result, I want to overweight technology based on this chart. Now, you might look at it and disagree. You might say, well, that relative PPO is going down. I don't want to overweight. I want to underweight. That's fine. That's your call. It's above zero. So as long as it's above zero, I'm probably going to want to overweight it. So then you go back to your, and you see that based on what you selected, you only have half of what the S&P 500 has in technology. So you might say, this is not the portfolio I want. You know, or you might say, hey, you know, I like consumer discretionary a lot better. And therefore, 21% of my portfolio is in consumer discretionary, which is quite a bit more than the S&P. And maybe this is what you want. But my point is, I think you should have a plan. And you should, you know, if it doesn't work out, you should know why. That's the one thing with our model ETF portfolio. If it doesn't work out, when we go to announce the next one, I'll be able to sit down and say, this is what happened. We had, you know, I might say our technology weighting was 32% and technology underperformed. You know, we thought it was going to outperform, it underperformed. But we should be able to bear the responsibility and be accountable based on whatever it was that we saw to make that selection. So I just think this is really important. So if you want to, you know, play around with this, I think this is pretty cool. I've already done some playing around with it, but we don't pick our next model ETF portfolio until January 19th, which will be coming up on a week from Tuesday. So now we're at 0%. So let's now take a little bit more aggressive approach. So let's say that you're really into, you know, one thing I'm thinking about that I'm looking at right now, kind of like my solar ETF 5%er, would be something like Hack. So, you know, maybe we do 5% in Hack. That gets into a lot of the cybersecurity stocks. And by the way, when you're putting 94%, whatever you put into Hack, 94% of it's going into technology, only 6% is going into industrials. So, you know, if you put 40% into Hack, that means you're going to have a lot of technology in your portfolio, which maybe you're okay with that. Everybody can decide how they want to do it. But this ETF Analyzer, I think, is pretty cool because it can really quickly give you an idea of what you're doing. Now I'm getting a pretty good representation of technology, even though I'm just using 5%. 5% of 93%, if you come all the way out here, is 4.69%. So these give you the detailed results of what that 5%, see how this adds up to 5%? 4.69% of your portfolio is now in technology. 0.31% is in industrials. So that's also out there. So you can take a look. If I up this to 20%, then I know I'm already at 18% before I add the other 95% of my ETFs. I'm already at 18%. I'm getting close to the S&P, and I'm going to be very concentrated in cybersecurity stocks too. If that's what you want, that's fine. Now you know what you own. But if it's not what you want, you want to be careful. I'm going to go back to the 5%. So what might I be interested in? And when I announced the last model ETF portfolio, I had a number of members write me and say, why didn't you include any of the ARK ETFs? And they've been strong, believe me. There was a reason why. There was one ARK that I was considering back in October, and I don't remember now, but it was between that fund and another one. And I ended up going with the other one because I liked the individual stocks better. But I looked through these, and there are some pretty good ones. And if you look also, look at the ownership in the various aggressive groups. Now, with financials just making a move, maybe you say, well, I need to see a little bit more out of financials. I'm not ready to go jumping into financials. Well, this one right here could be a staple because it's got a lot of what we're looking for. These are the other 4 aggressive groups. This might be my highest percent. I might go 25% into that fund. And then you can see where it's allocating. So now I'm getting another 9% specifically into technology. It's fairly concentrated. Almost half of the ETF is in 10 stocks. So it might behoove me to take a look to see what's in the stocks. Well, guess what? You can go over here to the top holdings. I'm not sure why is it not coming up? Oh, there it is. It didn't scroll. Okay. So here was fund 4. And so here you can go over here. There's your ETF number 4, top holdings number 4, 47.93. There's your 47.93. And so now I can evaluate. Well, look what it owns. Tesla. Look at the ARK funds. Tesla, Tesla, Tesla. Roku. Those are 2 model portfolio stocks for us. So clearly, and look at this one over here, it's got Square in it, it's got Pinterest. 4 of its top 10 are in our portfolios. Now, what I might consider doing is saying, okay, ARKQ looks pretty good, but I haven't followed MTLS. I have said I really like Deere. I've talked about Deere. That's a big one that I like. You've got Xilinx, Trimble, JD, which has been strong. It's actually been a little volatile over the last week. But you could go back and look individually at the charts and see if they're leaders. See what their scooter scores are. So you might get a better idea of whether or not this is the type of an ETF that you would be interested in. But if it is, and I'm just going to say, I'm going to definitely be considering these ARK funds. And I would be shocked, actually, if you don't see at least one of them in our model ETF portfolio as we go into the next quarter. But I'm just going to throw 25% into this because I do like the weighting here. And, you know, when I look at it, I've talked about industrials, that I want to be more involved in industrials. I also like communication services. So only 10% of this was in communication services, which is about equal to the S&P. So my next choice, I might want to look for something that's a little heavier in the communication services. So, well, communication services are huge there, 92%, but I don't want anything that big. Just going down. All right, Invesco, dynamic, leisure, and entertainment. Not much technology. I got a lot of technology in the last one. Consumer discretionary and communication services are huge. I don't know, maybe 20% in here. All right, so now I'm up to 50%. And now, just for the heck of it, let's get some widely diversified. 10% in the mid cap, Schwab, 10% in the small cap, Schwab. Mid cap, S&P 400, put 10%. And then let's see, anything else? This one's heavily into industrial, so maybe I say 10% there. And got one more 10%er. Where do I want to go with it? Let's say cloud computing is a big area that you're interested in. 10% there. Now we've got the 100%. Now you can look at your results. So technology, I'm a little bit overweighted in. Consumer discretionary, I'm almost double. I kind of like that. I'm 3% higher on communication services. I'm 9% higher on industrials. I've got some representation in financials, but it's not quite what the S&P has. And then when you look at the other areas here, you can see not really much in these other areas. So I'm deliberately underperforming areas that don't tend to do well in secular bull market advances. And I'm overweighting the other areas. And this, I think, is how you can build a portfolio that you can personally design that fits your strategy, that takes into account relative strength, because these ETFs, they don't put these together the way we put things together at EarningsBeats. But this is an opportunity for us to do exactly that as best we can. Now, if this isn't good enough for you, then you should be in the stock portfolios, because that's where we're hand selecting every stock. This is kind of gives us an idea of some of the things that we can do to give us a better chance to outperform the S&P with an ETF portfolio. And again, you can go over to, this is ETF number 10, the cloud computing. Let's see what they hold. All right, you got Fastly, Shop, that's shop.to, but essentially it's the same as Shop in the US. And, you can pull up these various ETFs, or excuse me, various stocks, and look at them on a chart and see if you like the group. But 42% are in 10 stocks. That's not crazy concentration, but still, these 10 will definitely have a pretty big influence. So if you like most of the 10, then it's going to be a stock that I'd be much more interested in. So anyway, I think this is a pretty cool spreadsheet. And it is downloadable now. So on the website, when you're logged in as a member at EarningsBeats, and you can get this, by the way, even if you're just a trial member. So just logging in as a trial member, you can still go to just about everywhere on our site. We do have a couple of things that are reserved for annual members. They're just things that we require more of a commitment. But this actually, that's not, no, webinars is, I think, where it is. Sorry. Nope, it's not there. ETF webinars. Let's try that. Here we go. So here is your EB ETF Analyzer. So when you're logged in, you just go to ETFs and look at ETF webinars, and then you'll see this. And as we go forward, if we do a webinar like the one we're doing today on ETFs, then it's going to be listed here under ETF webinars. If we do one that's related to stocks, it's going to be just webinars here under the stocks. Okay. So if you're looking under where you normally go, because this whole ETF section's new, if you normally go to webinars and you don't see it, make sure you check. If it's an ETF webinar, check the ETF webinar department. But anyway, here you can see, here's the EB ETF Analyzer. So if you've got a spreadsheet and you're capable of downloading those, you can just click on this and you'll have it on your own computer, which I think is pretty cool. All right, the model ETF portfolio draft. Last thing I want to talk about, and then we can wrap this up. That's coming a week from Tuesday. Already told you a little bit about what we do. I'm going to pull that up. Let's go up here. The model ETF portfolio. So here are, oh, I put the wrong thing in here. That's not the portfolio. You get to see again. Let's go into, that's where I had downloaded. I thought I had downloaded the strong ETF chart list. So if you go into portfolios, actually, let's go into chart lists. And that's not down there. I think everybody's ahead of me here at EarningsBeats. We've probably already moved it. Yeah, there's the model ETF portfolio chart list. So here, now this is the one I wanted to actually copy. So copy, and then you click on this, and that was what I wanted to show you earlier. So here's your prompted to put the password in. Make sure you put the password next to the link for the chart list. All these passwords for our chart list are different. This is not your EarningsBeats password to get into your account. It is not your stock charts password. It is the password that is sitting next to the link. Make sure you grab that and then paste it here. Unlock the list. Now we've got the 8. Now, if you're not a member, what you can do when there's only 8, you can simply just scroll through. You'll be able to scroll through and check this out. But what we're going to do is I'm going to save it. And I'm going to replace what I thought was the model ETF portfolio right here. And so now I'm going to save it. And it is successfully saved. So now when I go into should have it right here. Now I've got the 8 portfolio ETFs. So there are the 8 ETFs that we included in our current portfolio, and we'll be adjusting. And there is the percentages that we put into each one. So 20% is in the online retail, 15% is in the QQQ, 15% is in the IYT transportation, 15% is in the S&P 500 growth ETF, 10% is in home builders. That's actually not been a very good one of late. 10% is in technology ETF, the XLK. 10% is specifically in internet stocks, and 5% is in that clean energy that we talked about. And so what we'll be announcing a week from Tuesday is which stocks we'll be going into, and we'll again bring up that EB ETF Analyzer to show you exactly what the relative percentages are for each of the sector ETFs or sectors. And we'll be comparing that to the S&P, and I'll be explaining why we're doing what we're doing. And then you can decide. You can say, hey, I agree with you. I don't agree with you. Here's what I would do to change it. But you're going to have a lot more information to work with than you have any place else. I think this is a tremendous service, especially if you're an ETF person. But even if you're not, if you're somebody that's into the stocks and you want to be just a little bit more conservative, you might think about, maybe including the Motto ETF portfolio with a portion of your investments. And again, I'll stress this, I always do. We are not registered investment advisors. I am not advising anyone to buy anything. We are an educational company. We do a lot of research. We provide a lot of education. And what I look at is simply this being very educational. And if you decide to do it with your money, that's your risk. Just want to make sure everyone understands that. But, I think that the education and the research we provide certainly helps in putting together something that makes a lot more sense for most investors. So that's what I had for today, John. Don't really plan to go into anything else. I will just kind of point everyone back to this webinar special one last time. You can save $300 right now. If you take out a trial and your trial expires in 30 days, this $697 deal is not going to be there. So that we just want to make sure you're aware of it. Try to get you the best deal we can. We are raising our price to $997, and that will certainly be in effect when your trial comes due. So this is an opportunity to extend your membership for 12 months for that $697, a huge savings, $300 right off the bat, and you won't have to worry about paying extra for our service until you renew in what would be over a year, because you've got 12 months, plus you'll get your 30-day trial. So it'll be a 13-month deal. Any existing members, it's not just for new members, any existing members, you can take us up on the $697 offer right now to extend for 12 months. You get everything you've been getting, but you're also going to get the ETF service that we talked about here. And it's not just the analyzer, but it's also going to be this sector allocation ETF portfolio that we're going to be announcing later this month as well. So a couple of really good portfolios coming up in the ETF area. All right, I think I'm done. John, anything to add?
No, that was excellent. And we had a few questions along the way, but I was able to answer them. So I think between my answering and your explanations of everything, that we have responded to everybody. And I do want to just remind a couple things. Again, this is one of what we call a public event, open to all community members of EarningsBeats. The Tuesday Max Payne webinar, that'll be a member only, and that's always very, especially with, I get giddy about this because we've had such a run, and you can see the Qs, the spiders, and some stocks have had great runs with options expiring monthly next Friday. That's going to be quite interesting. So the Max Payne option webinar will be Tuesday. That's a member only. Then we get into next week. We'll have our on Monday, week from Monday, that'll be a public sneak preview of our Q4 earnings. Then we'll have the draft on the 19th, the ETF draft, which I cannot wait. We've had great success, by the way. People don't know this. I actually featured it in my Chart Watchers article that the first model ETF portfolio Tom was talking about that came out on October 19th. It's up almost 15%, 14.9. The S&P, same period of time, 11%. So almost a 5 percentage. That's a big beat, I should say, with our goal to beat the S&P. So the next reveal will be on the 19th of this month. The next model portfolio group will come out on that date. That's a members only. You've got to be at least a trial member or a full member to get access to that. And then the following week will be the Q4 earnings webinar. So just a lot of stuff coming up, Tom, a lot of great events.
Yeah, I think also with the Max Payne, I remember last month we did Max Payne. Occidental Petroleum, OXY, we talked about as being a stock you want to be very, very careful. I think the stock went down 13% the next week because there were so many in the money call options on Occidental. And then I think the other one was Moderna, which went down 20% within, I think, maybe a week, maybe 7 trading days, something like that. So you've got to be careful. And, specifically looking at some of our portfolio stocks, I mean, I think Tesla and I think Roku, if you're a trader, you got to be really careful. If you've been riding these two stocks going into options expiration week, they have been soaring, and I haven't even looked at the options, but I could promise you that there is a ton of in the money call premium. So, at least maybe thinking about and I'm talking trading perspective. I'm not talking about portfolios. Portfolios, we hold them for the full 90 days. We don't try to time entry and exit. We just hold them, and it's worked out very well for us. But I'm talking about if you're a trader and you think a 10 or 15 or 20% move lower is unacceptable, you might want to be really careful with some of these stocks that have had huge runs, because as we move into options expiration, it doesn't mean that we have to go lower, but there is financial incentive for some of these stocks to pull back, and they've made huge runs. So just throwing it out there that maybe, taking a little bit off the table as a trader wouldn't be a horrible thing on some of these stocks, especially if they continue to go up in the early part of next week and as we approach options expiration next Friday. And the other thing I'll mention is a lot of people think, options expiration, it's over on the Friday. It's not over, because anybody who exercises their options, market makers are on the other side of those trades. So it goes into the following week. That's why I always say you got to be careful into the week of options expiration and the week following. And history bears me out. That's when the market tends to struggle once you get to that option expiration Friday, and maybe even a few days after. So that would be something I just want to point out. So going to be Tuesday's going to be very interesting. I'll probably have plenty of candidates to talk about.
Okay. And I want to make sure everybody knows they'll get a copy of this recording. As soon as it's available, we'll get it out to everybody. And Tom, I think that's it. Wish everybody a great weekend.
Yeah, everybody have a great weekend, and Happy New Year, everybody. Finally out of 2020. I will end it with one little funny thing I saw. I think somebody on Facebook had posted it, but it was a thing, I guess, with everything that took place around, the Capitol this past weekend. Somebody posted a meme and it said, 2021, you were great for 5 days. Looking forward, or cheers to 2022 or something like that. And I just had to laugh. We get through the pandemic, and then of course, what we saw at the Capitol was just ridiculous. Anyhow, you got to laugh though, right? I mean, can't laugh. I don't know what you do, but anyhow, everybody have a great New Year. And I got to say, don't want to offend anyone, but I'm a long time Redskin fan from the Washington, D.C. area. We have a playoff game today, and I know it's the Washington football team, but I wear Redskins like a badge of honor. And my family's we were season ticket holders for 58 years. And for what Ron Rivera, head coach of Washington, has done this year, going through cancer, Alex Smith coming back from that unbelievable leg injury 2 years ago. That's quite a story. And going up against Tom Brady, I mean, it's going to be an interesting game. So I'm pretty excited to watch that game tonight. But anyway, everybody have a great year. Hopefully things will continue to improve. Stay safe, and we'll get through all this together. Everybody have a great day.